Warren Buffett calls him the father of value investing, and chances are you've never heard his full story. Today on Stonkcast, we are beginning our mini series on value investing. Stick around. Welcome back to Stonkcast, the market show for the average Joe, whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host as always, Brandon Shar, and folks, as promised today, we are kicking off our value investing mini-series. This will be a 4-part. Today, we're going to tackle who Benjamin Graham was, and then next Saturday, we'll shoot the next one. Again, this will be a 4-part series. Today's will be, pretty short. Just want to give a brief overview of who Benjamin Graham was. So if you are interested in value investing, you're in the right place. So let's kick it off. Benjamin Graham. He was born in 1894 in London, moved to New York with his family, and unfortunately his family lost everything in the panic of 1907. This really shaped his obsession with financial safety, which is one of his lasting principles when it comes to investing. And this is really a kind of a side point here, but I read the books Psychology of Money. Maybe you've heard of it, maybe you haven't, but one of the principles of the book is that depending upon when you were born, when you grew up, who your family was, really influences the way that you view money. So for someone like Benjamin Graham, it makes sense that he was more conservative, right? Because he saw his family, lose everything in the panic of 1907 versus someone who came up, let's say, in the dot-com era, where anything you were buying was going up. So a little background on Benjamin Graham and part of the reason why, he was so conservative in his approach. Benjamin Graham, during this time frame, right, on Wall Street, things were a bit shaky. Obviously, you had the panic, and then not to mention the fact that not too long after that, a couple decades, right, you had the Great Depression. So really, Benjamin Graham came up through all of this in the early stages of, Wall Street turning into what we now know it as, which is, the greatest, stock market in the world, right? It's large. You got the NASDAQ, you got the New York Stock Exchange, trillions of dollars. And so these were kind of the early days of it that Benjamin Graham experienced. So as far as education goes, Benjamin Graham went to Columbia University and graduated at 20 years old. Pretty impressive. And started on Wall Street, eventually opening his own investment partnership. So what made Graham different, right? So most people, at least, that probably watch this show, and most of the people that, I've seen when it comes to the stock market of late would be classified as speculators, right? That's what I do. That's what majority of us probably do based off technical analysis, other things like that. We're speculating where a stock is going to go. Benjamin Graham, however, was not a speculator. And this is one of the key differences that he highlights. Graham was calculated. He wasn't a speculator. He was very conservative. He made sure that he focused on the quantitative side of things, meaning, for Benjamin Graham, it was about the numbers, right? It was about it was about how many assets a company had. It was about how many liabilities, those types of things. So that's really what made Benjamin Graham different. Well, you had a bunch of speculators on Wall Street. He was more calculated. And just as an example, there's a book reminiscence of a stock operator. Yes, Jesse Livermore. That's somebody you would classify as a speculator. That's also a fantastic book, so highly recommend that as well. But Graham, way different from Jesse Livermore, who was a trader. Graham was an investor, right? He pioneered the idea also of intrinsic value, what a business is really worth, no matter the market price. So you can have, let's take Tesla for example, right? Tesla is trading, just under $300 a share, right? But for Benjamin Graham, it's not about what it's trading at on the market right now. It's about what is the intrinsic value of Tesla in this hypothetical, right? What is the actual value of the company? So that's what Benjamin Graham would focus on. His big idea was that price is what you pay, value is what you get. So for him, it was really important to make sure that you're not overpaying for companies and that you are actually getting good value, what he would classify as a margin of safety. He believed you should treat stocks like buying part of a real business, not a lottery ticket. Something I'm definitely guilty of, and something that a lot of traders that are, on the short term spectrum, they're not really viewing it, nor really should they. It's different. They're not viewing it as, when they're trading Tesla, for example, oh, I'm an owner of Tesla, right? And so for Benjamin Graham, the big idea here is that you're owning a piece of a real company, right? And if you're going to own a piece of a real company, you want that company to be successful. You want to understand how it works. And so this is really, and maybe I should have let off with this, but there is a very distinct difference between a trader and an investor. And this mini series that we're doing is going to be on investing, not trading, not speculating, right? We're not looking at 0 day to expiration options, right? This is primarily for those who want to take a longer investing philosophy and maybe apply it to your 401k, or if you have a separate account for the long haul, right? The whole purpose of this is to give you some ideas as to how you could approach the market the way Benjamin Graham did and the way that Warren Buffett now does, right? Not financial advice, to be clear. But anyway, so, he believed, again, you should treat stocks like buying part of a real business, not a lottery ticket. And here's this interesting quote. In the short run, the market is a voting machine. In the long run, it is a weighing machine. And so, the way I take this, the market is a voting machine in the short run, meaning you're going to have companies that get hot, right? The sentiment's high, they go flying up. Think of any number of penny stocks that I'm sure you've seen. But in the long run, it's a weighing machine. So in the long run, the companies that are genuine are going to be hanging around. The ones that aren't are going to be the ones that get delisted from the market and go under, declare bankruptcy, all the above. So as far as Benjamin Graham's legacy, right, why he still matters. So he wrote 2 of the most influential investing books ever, and that is not an overstatement in the least. So one of which is Security Analysis. He wrote it. I'm not sure when he originally wrote this one. I mean, this picture, for those on YouTube, you can see here this, the classic 1951 edition. So I guess 1951, right, was when this book came out. But Security Analysis, self-explanatory, right? But this is a very in-depth look at how to analyze stocks, how to analyze companies, I should say, right? And how Benjamin Graham and technically David L. Dodd, who also co-wrote this with him, how they would approach, the process of analyzing companies. The second one that he wrote that is a bit more well-known would be The Intelligent Investor, right? And this is actually what I'm actually going through right now. The definitive book on value investing. Now, look, there's been a ton of revisions on this book because you have to keep in mind when Benjamin Graham wrote it, we're talking, almost 100 years ago, right? So obviously things have changed as far as, inflation and company values and things like that. So there's been quite a few revisions. This is, I could be wrong, but I believe this is the latest one. And so this is the one I've been going through, which has been just fantastic. He taught at Columbia. His students included Warren Buffett, Walter Schloss. Maybe I'm mispronouncing that, but Warren Buffett, everyone knows, and many other legends, right? So Warren Buffett, obviously a well-known investor, and really at the time of recording here, this is timely because Berkshire Hathaway just had their annual shareholder meeting today, in fact, and Warren Buffett announced that he will be stepping down as CEO at the end of the calendar year. So pretty massive news for a guy who has just had such an incredible run when it comes to investing, and everything he has done has been based off Benjamin Graham. So very, very interesting. Graham's principles still form the core of long-term investing today, especially during volatile markets, right? So especially right now when we seem to be getting some more volatility, especially now, right? You can actually find some good value based off of Benjamin Graham's, philosophy. So in part of the reason why I think this matters right now and why I'm doing this right now, think about AI stocks, think about high inflation, think about market bubbles, right? Investors need a margin of safety more than ever, right? There are plenty of hot stocks going up, things like that. And again, to be clear, not talking about trading, talking about investing. If you're looking for investments, right, you want a margin of safety, as Benjamin Graham would call it. And in light of the AI frenzy and various things going on right now, it's all the more important. So, this is very short and sweet. Just wanted to give a brief overview of, Benjamin Graham, who he was, and really why it matters. Again, we're going to be continuing this mini-series. Like I said, it'll be a 4-part series. I'll be back next week, try to get these out on Saturdays. We'll see how that goes. But as for now, that's what I got. We'll be back tomorrow for a market recap, as always, on Sunday, and see what we got heading into the week ahead. But as for this, that is the story of Benjamin Graham, the man who taught us that real investing isn't about predicting the future. It's about protecting yourself when the future surprises you. In the next episode, we'll break down Graham's simple but powerful philosophy and why it's even more important in 2025. Don't forget, hit subscribe if you want to build wealth the smart way. And make sure to leave a comment. Let me know if you've read the book or plan on reading it. And we will be back tomorrow. And as always, doesn't really pertain, I guess, to investing, but the signature sign off. I just love it so much for the traders, for the degens out there. Folks, plan the trade and trade the plan. Have a good night.